All right, so what are your financing options when you're buying multifamily properties? Let's talk about it. All right, you really have three primary options when it comes to financing your multifamily properties. You've got one being bridge loans, you've got two being agency loans, and you've got three being your local lenders. So let's take a few minutes to talk about each one. One is a bridge loan. How this loan looks is just going to be sort of a short term, maybe on the low end, it's going to be 1 year. At the very maximum, it's going to be 5 years. So this is going to be a loan, and the purpose of this loan is to get you from where you are today with the property to where you're going to be in the future, right? So these lenders are loaning you money based off of your future evaluation. They may loan you the money to buy the property. They may also loan you the money to do the repairs on the property. This is something that I didn't know when I first got started. I had a major rehab project and I just bought it from a bank, and I didn't have any of the repair costs I needed. Cost me months, if not years of time to try to find the money to repair this thing. But it's not going to happen to you because you're looking at this video right now. You know that you can go out and approach bridge lenders. You say, hey, I want a bridge loan. I'm going to buy it here. I'm going to make it more valuable in the future. I want you to loan me money to get it to that future evaluation. And when I do, in the next 1 to 5 years, I'm going to take you out and refinance the property with something else. So that's one. They talked about bridge loans. The second type of loan is what we refer to in the industry as agency loans. And these are your big lenders that have their standard criteria. This is Fannie Mae, this is Freddie Mac, this is institutional capital that comes into the multifamily market. The benefits of this type of loan is that you're going to get some of the most aggressive interest rates that are out there. You're also going to get some of the best terms, right? You could be looking at 30-year terms on a loan. You could be looking at interest rate depending on where the market is, but the lowest of the low that you could find will be in the agency lenders. Now, the downside of agency lenders is that they usually want you to basically, you got to check all the boxes in their model, right? So they may have income requirements, liquidity requirements, experience requirements, and you got to be able to check all these boxes. Now, you can do those because you're going to be creative, right? Whatever you don't need, you just go out and you find it. But you have to check all those boxes to be able to get one of those loans. The downside, again, is just that they typically tend to be long-term. And to get those best rates, usually you have to sign up for a long term. So if you're going to turn a property over in 3 years, you may not want to take a loan with an agency that's going to set you up to do a 10-year loan because they have penalties if you exit a loan early, right? So that's something for you to keep in mind. We won't go into how that looks and how to avoid it right here, but just something for you to know. So we talked about bridge loans. We talked about agency loans, and now we want to talk about local lenders. And local lenders are going to give you really a combination too, right? Your local lenders, when you think about that, you want to think about the small bank that's close to the property, right? So if you're getting started and you're buying 20 unit, 30 unit, whatever it is, you may not want to run out and get one of those big agency loans. You may want to check in with a lender who's close to that property or who does a lot of loans in that market. They will usually hold the loan in-house, meaning you're making payments right to the bank that you bought it from. Or, sorry, you're making payments to the bank that loaned you the money. A lot of times if you do one of the agencies, they end up selling the loan off to somebody else. But the good thing about the local lender is that they will oftentimes give you better terms on more riskier assets if they understand or they like the market. So if they've got loans in that market already, they like your market, they'll give you terms. The other thing is they don't necessarily have the stringent criteria that some of the agencies have. The agency may say you got to check, 10 boxes, Whereas your local lender may say you only got to have 2 or 3, and it could be very relationship based, right? So you talk to a loan officer, they understand your business plan, what you want to do. They could come up with some pretty interesting terms for you. One thing that I did not talk about, and one of the biggest advantages of the agencies, is the fact that they have non-recourse debt. And what that means is, unless you do something wrong, you're not going to be liable for the loan if things go south. So you could buy, multi-million-dollar real estate deal, and for whatever reason you can't make the payment. It doesn't go on your personal credit. The bank says we'll just take the asset back. On some of the local lenders, they usually want you to sign, which means you're giving a personal guarantee. So if that loan does not perform, you're going to be personally liable for the debt. So each one of these loans has its upside and its downside, but it's going to be one of those you have to take your specific project and then compare terms. And oftentimes, once you do it a while, you'll know the proper terms for, or the proper type of loan terms for the type of asset that you're buying. But in the beginning, you may want to just toy around with each lending model to see which one fits your project the best. So those are the type of loans you can look to get in multifamily. Hope you found that helpful. Continue to follow. I'll be talking multifamily, trying to help you get into your first or your next multifamily deal. So if you found this helpful, leave a comment, like, subscribe, and I will see you in the comment section, or until next time on a video. Take care. Have a good one on purpose. Later.